Recently, stock markets corrected about 25 to 30% in India. And lots of my friends and my investors, they called me and they were inquiring about which company shares they should be buying. There is a huge difference between buying a shares and buying a mutual funds. Today we are going to see the difference between it. So you will be in better position to take your own decision whether to go for a direct equity or go for a mutual funds. Direct equity or equity mutual funds. Whether to go for the direct equity or the equity mutual funds, it depends on the 5 factors we need to consider. The first factor is how much risk appetite we have. The second factor is what kind of returns we are looking for. Third is how much time we can spend or allocate for the portfolio management activity. Fourth factor is how much resources access we have, and the fifth one, what kind of expenses we are looking out for. Let's compare these shares, direct equity and the mutual funds on the basis of the risk. Shares are riskier as compared to mutual funds as it lacks the diversification. You may own shares of a few companies and certain set of sectors only. So then when those sectors perform well, you have a good returns, otherwise you may end up having losses. The second point is you may not be able to devote time required for the analysis. As you know, as most of us, we are not 100% dedicated, can't dedicate our time for our portfolio management, because we are into some other profession where we have to do, either we are in the business or in the job. We have to pay more attention onto that than managing the portfolio. The third point is you may not have an access to enough data to analyze the shares. Like say when you analyze the share, you need lots of data, like how much is the projected sales is there, how much is the cash, how the cash flow of the companies, then how much is the P, the forward P, those kind of data. In case of mutual funds, if you look at the mutual fund is a pool of shares of different company. So it's less riskier as it is a well diversified. A single mutual fund schemes hold between 0 to 50, between 10 to 50 stocks in it, or sometimes maybe more. A dedicated team. The second point is a dedicated team of experienced professional who manages your portfolio. Every mutual fund scheme, they have a team of analytics who supports them and produce the reports for them and advise them on which sectors, which companies to be invested money in. The third, this management, they have an access to the whole lot of the data which is required. As good as you know, these fund managers, they sometimes have they speak directly to the management of the company to understand their future business plan and the future projections. Now, in terms of return, when we compare share and mutual fund, the first point is shares are riskier than mutual fund. As we spoke, it can give you a high return. It is always there in the investments. The higher the risk, the higher the returns. Except when you have a share of a single company and that company performs well, you may have a multifold returns. Like the returns given by the MRF are far more than the returns given by any other single-handedly MRF, or in that case the returns given single-handedly by the Page Industries. They are far more more than any mutual funds. So but again say they fall far more compared to any other diversified funds. Second point is shares are diversified, shares are not diversified, so it can lead to the losses as well, as I explained. In case of mutual funds, the mutual funds are diversified, so it gives a comparatively less returns of the return compared to shares. We already see that. When market goes down or some sector or some segment performs bad, it has a less losses losses compared to the direct equity. As you know, like say now this year, due to some reason the the software industry is not performing well. But since the mutual fund scheme is diversified across the sectors, so your fund NAV won't go down as compared to the share or a stock of a particular software company. Now compare the shares and the mutual fund in terms of the ownership. Shares, you own a percent of company ownership. That can be very small as well. The second point is you make money either when your company pays you a dividend or you sell and book profit when your share price appreciate in the market. Third, the price of share varies during the trading session. So when you decide, like say if I decide I'm going to buy Infosys at 115 rupees, so I put up a order for 115 rupees. Now whenever that price, the market reaches to that price for that company, well, I'll be getting those shares, so the price at what I want to buy is decided by the investor. Secondly, the shares you can buy either you buy from the secondary market, from the open market, or you get shares when there is a public offers, when the IPO is there. Like so the recently IPO of the SBI card happened. In case of mutual funds is the pool of the shares of a multiple companies. So you own a unit in the mutual funds. So that one unit of mutual funds has some very micro level percent of the share percent of all the stocks which that mutual fund is holding. Second, you make money in mutual funds either when the appreciation happens and you sell and you get the capital gain, or secondly if you have dividend option selected, so you can get whenever there is a dividend declared from the mutual fund schemes, you get those dividends. About the NAV at which you want to buy a mutual fund is not decided by you. The NAV of any mutual fund scheme is declared end of the day. So when you invest, like say you have to invest before 3:30 p.m. or 3 p.m. So when you apply for the mutual fund, you decide only the how much amount you want to invest, and then next day you come to know with that amount how many units you got and at what NAV you got. Buying a unit you can do two ways. First, if the scheme is open-ended, then you can buy and say you can subscribe and redeem the units of mutual funds. Secondly, you can buy units when the NFO happens of any mutual fund scheme. Now let's compare the shares and the mutual funds on the basis of the charges and the expenses. In case of shares, you pay brokerage as when you buy or sell the shares. So every time you buy a share, you have to pay a brokerage, which comes, and then you as well pay the annual demat charges. Like say now all shares you hold, they are into a dematerialized format. So in that format, you hold them with the demat account with the certain banks, and those banks they charge you some fees annually. Secondly, when you buy and sell the shares, like say if I buy a shares and if I have sell and if I have a long term or the short term gain, I have to pay a capital gain appropriately, whether it's a long term capital gain tax or the short term capital gain tax. In case of mutual funds, annual expenses of the mutual funds are between 1.5 to 2.5% is applicable, which is deducted while calculating the NAV itself. So when you buy a mutual fund at a certain NAV, it includes the annual charges of that mutual fund scheme. Secondly, when MF, when the mutual fund managers, they buy or sell mutual funds, and when they sell, if they have a gain for that shares, those capital gains you don't have to bother about. You only pay a capital gain when you redeem units of a mutual funds and you have a gain on those mutual funds. So it's not like say even if the mutual fund managers did this book the profit in certain shares of his basket 10 or the 15 times a year, so you don't have to worry about that. You only pay a gain tax only when you have a gain on the when you redeem the units of a mutual fund. Now let's compare the shares and the mutual funds on the basis of the investment amount and the folio size. In case of shares, one need to have a decent size of portfolio. Like say if I wish to have a decent amount of diversification and want to hold the shares of 10 companies, and the one of company is MRF, then MRF a single share price is about 30 to 40,000 rupees. And similarly, in case of Page Industries is again the same. So to have a more than one share, my folio size should be a decent size. And again, while setting up the SIP, it's not easy for the shares to, when I go for a direct equity to have an SIP. Like say now to buy a one share, I can't buy a half share of the MRF or half share of the Page Industries or half share. So I have to have minimum a single share in my SIP. So my SIP amount again depends on my folio which all shares I want to get into SIP, but that's going to be a higher size. In case of mutual funds, you can start investment with money as low as 500 rupees. There are certain funds they accept 100 rupees as well. Plus, you can do SIP of the mutual funds again with the amount as low as 500 rupees a month. So anyone, irrespective of his folio size, can invest in diversified mutual funds. Conclusion. Now the direct equity, investors who are HNI in nature, it suits them. Secondly, it has those who have a high risk appetite can consider going direct equity. Third, has a sufficient knowledge about the equity, because you are the portfolio manager for your investment, so you need to have a sufficient knowledge of the companies and everything by analyzing companies, deciding on which companies to buy. Third, you need to dedicate certain amount of time to manage your portfolio. And then lastly, the resources for information and analytics you need to have. Like say you before you conclude to buy a company share, you need to have their sales figure, the cash flow, how much they have, how much debt they have, plus what PE they are running on, what is the forward PE they have, how's their order book. So these all information you need to have handy with you, or you need to have access to it, so you can conclude on buying a certain company share. In case of mutual funds, suitable to all investors irrespective of the investment amount. So you don't need to have a high amount as we have seen on the previous slide. So you can have even the 500 rupees if you have the to be invested, you can go for the mutual funds. Even HNI should allocate, in my opinion, even the HNI should allocate about 60 to 80% of their investments in the mutual fund so as to have a good diversification of their portfolio. Mutual funds are easy to buy. So you like say if I wish to buy 10 shares, I have to make 10 transactions. Wherein if I subscribe to if I buy 1 unit of a mutual fund, I'll have as good as buying a basket of 40 or the 50 shares. Mutual funds are very easy to track. NAV of the mutual funds is declared every now and then. Your fund performance is always, you can very easy to compare with the indexes, benchmark indexes, which is you need to. Plus you get reports about the mutual funds very easily by just either by visiting to the CAMS website or the Carvi website, or you can directly going by the AMC website. The taxation calculation, mutual fund AMCs or the intermediary, they give you a capital gain report and all in all. So here we can decide which whether to go for the mutual funds or whether to go for the direct equity. Thank you very much.